Good afternoon, everyone, and thank you for joining today's webinar. This is Grace Lee, Consumer Compliance Policy and Outreach Specialist. Before we start, here are 3 technical tips to make sure that you can see the console and hear the presenters. First, make sure you allow pop-ups from this website. Second, if your display is not clear, set your screen resolution to at least 1024 by 768. Then you should be able to see the webinar slides. Finally, if your volume sound is too low, make sure that your volume is turned all the way up, both on your computer and on the console. I will now turn it over to Matthew Baloris, Director of the Office of Consumer Financial Protection.
Thank you, Grace, and thank you to everyone who's joining us this afternoon. Let me take just a few minutes here to highlight the agenda for the webinar. First, you'll hear some opening remarks from Chairman Hood. Then 3 program officers from my office, Lisa Rogerson, Matt Nixon, and Al Brantley, will talk about specific fair lending and consumer compliance issues. After that, we'll spend the rest of the time answering your questions. And I do want to thank you. We did receive some questions in advance, and I do thank you for sending those in. And please don't forget, you can always submit questions anytime during this webinar by typing them in the submit question box in the lower half of your console. All right, with that, I think we're ready to begin. As you may know, Chairman Rodney Hood took the oath of office on April 8, 2019, becoming just the 11th chairman of NCUA. Chairman Hood is the first recipient of the DREAM Award, designated by the Wells Fargo Housing Foundation to honor those who have exhibited an outstanding commitment to affordable housing. As NCUA chairman, Mr. Hood serves as a voting member of the Financial Stability Oversight Council, and he is the current vice chair of the Federal Financial Institutions Examination Council. With that, Chairman Hood, thank you so much for joining this afternoon, and the floor is yours.
Great. Thank you, Matt Baloris. Good afternoon, ladies and gentlemen, and welcome to the NCUA's Fair Lending and Consumer Compliance Regulatory Update webinar. I hope that you and your families are all safe, healthy, and well. It certainly is a pleasure to welcome all 1,300 of you for today's webinar. And in fact, I think since we've started, perhaps that number has grown even more. This is, in fact, perhaps one of the largest groups we've had in quite some time. We, as hard as it is to believe, are now in our 9th month of the COVID-19 pandemic. The COVID-19 pandemic has revealed a concerning aspect of American life. Even in the age of relative plenty and prosperity, inequalities continue to plague our nation. The pandemic has had a disproportionate and deleterious impact, notably on communities of color. That stems in part from economic opportunity, an area where leaders in the credit union industry can have a powerful impact by making a commitment to a financial inclusion agenda. Here at the NCUA, we launched Access, Advancing Communities Through Credit, Education, Stability, and Support. This is NCUA's new financial inclusion initiative, which builds on the agency's past successes to bring more Americans into the financial mainstream. Access will include expanded policies and programming in the areas of access to credit, consumer financial education, stability for credit unions serving underserved areas, and support for greater employment and procurement opportunities among diverse communities. Through Access, NCUA will support the people helping people ethos, which is integral to the credit union system. Over the course of the COVID-19 pandemic, the NCUA has taken prudent and meaningful measures to provide guidance and regulatory relief to the credit union industry and the more than 122 million member owners they serve. Where possible, we have been proactive in our approach to COVID-19 relief from the CARES Act provisions, including changes to the Central Liquidity Facility. I'm pleased to say that nearly every rule the NCUA Board has considered in recent months has been related to COVID-19 relief. Additionally, we've issued over 25 pieces of guidance and advanced several rulemakings, all with the intent to give credit unions the flexibility they need to continue serving their member owners during this trying and challenging environment. I want to note that our examiners continue to conduct examinations and supervision contacts remotely. The remote examinations have been quite a success, I'm pleased to say, and the feedback we've received from the industry has been very, very positive. We've been able to successfully continue our exam and supervision activities because of the flexibilities of credit union staff. Thank you all for your diligence, professionalism, and hard work. During today's webinar, staff from the NCUA's Office of Consumer Financial Protection will present the consumer compliance focus areas for the agency's exams in 2021, which include a review of COVID-19 related loan modifications and credit reporting, as well as a review of fair lending. This presentation will also cover findings from the 2020 Consumer Compliance Exam Reviews. Even though they've been working in an off-site posture, examiners have been able to identify consumer compliance problems for credit unions to address. Finally, staff will discuss observations from recent fair lending exams to assist credit unions with their fair lending compliance efforts. I hope you all find today's webinar both enlightening and insightful. And again, welcome all of you. Thank you. And I now would like to turn the floor over to Grace Lee. Grace, the floor is yours.
Thank you, Chairman Hood. This is Lisa Robertson. I think Grace is having technical difficulties. I'll quickly go over the disclaimer in today's agenda. The materials presented in this webinar are intended as an informative and educational summary of the general information related to consumer compliance focus areas and fair lending. The NCUA has taken reasonable measures to ensure the quality of the data and other information produced by NCUA that is available in this presentation. The NCUA, however, makes no warranty, express or implied, and does not assume any legal liability or responsibility for the accuracy, correctness, or completeness of any information that is available through this presentation. The slides are intended for educational and discussion purposes and do not constitute legal advice. During today's webinar, we will present the consumer compliance focus areas for the agency's exams in 2021, which will include a review of COVID-19 related loan modifications and credit reporting, as well as a review of fair lending. This presentation will also cover findings from the 2020 Consumer Compliance Exam Reviews. Good afternoon. Once again, my name is Lisa Robertson, and I am a Program Officer in NCUA's Office of Consumer Financial Protection. Today, I'm going to discuss next year's Consumer Protection-focused examination scope activities. Next year's Consumer Compliance Exam Scope activities will focus on fair lending in areas related to COVID-19, specifically loan forbearance and limits on credit reporting. The fair lending focus will include a review of the resources credit unions are devoting to fair lending. Matt Nixon will discuss the 2021 fair lending scope activities in a few moments. I'm going to briefly review the COVID-19 loan forbearance and limits on credit reporting scope areas. Examiners have already been focusing on temporary relief provided to borrowers negatively affected by the pandemic. This includes areas such as loan modifications, records retained, loan loss allowance, procedures and controls over workouts, and management reporting systems. Examiners may also consider the credit union's procedures and controls for reporting loans and forbearance to the credit reporting agencies. In March 2020, NCUA issued a letter to credit unions that provided a number of strategies for credit unions to consider when determining how to work with their members to address the challenges associated with COVID-19. NCUA was clear that credit unions whose efforts were conducted in a reasonable manner with proper controls and management oversight would not be subject to examiner criticism. To be clear, and as discussed in the guidance, when working with borrowers, lenders and servicers should adhere to consumer protection requirements. including fair lending laws, to provide the opportunity for all borrowers to benefit from these arrangements. During examinations and as regulator, NCUA will take into account the unique circumstances impacting borrowers and credit unions resulting from the COVID-19 pandemic. While considering size, complexity, and risk profile, examiners will take into account a credit union's good faith efforts that are designed to support consumers and comply with the consumer protection laws. Examiner feedback to credit unions will be focused on identifying issues, correcting deficiencies, and ensuring appropriate remediation to consumers. Consumer compliance scope steps for 2021 will include reviews of forbearance and other accommodations credit unions have provided to their members during the pandemic. The 2021 Consumer Protection Reviews will focus on mortgage loans and non-mortgage loans, with the category of mortgage loans being divided into a subset of CARES Act loans and other mortgage loans. The objective of these reviews will be to assess the credit union's compliance management systems and ascertain whether the credit unions are effectively managing the loan accommodation process. This assessment will include reviews of whether credit unions are offering borrowers available forbearance options fairly and consistently, properly handling documents submitted by borrowers experiencing a financial hardship related to COVID-19, properly servicing loans in forbearance, and not misleading borrowers about any aspect of forbearance or other accommodation. On March 22nd, the federal financial institutions regulatory agencies and the state financial regulators issued a joint policy statement on loan modifications and reporting for financial institutions working with affected consumers. On April 7th, following the enactment of the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act, the agencies issued a revised statement. The intent of the policy statement was to facilitate mortgage servicers' ability to make prudent arrangements to mitigate the long-term impact of this emergency on consumers by avoiding delinquencies and other adverse consequences. The statements provided credit unions with flexibility and guidance related to early intervention and loss mitigation. The policy statements address mortgage servicers' good faith efforts to provide required notices and take certain required actions when working with consumers affected by the COVID-19 emergency. The statements indicate regulatory agencies do not intend to take supervisory or enforcement action if mortgage servicers make good faith efforts to provide notices and take actions required by the mortgage servicing rules. Do so within a reasonable time, correct deficiencies, and ensure appropriate remediation to consumers. The statements encourage credit unions to consider accommodations that can ease cash flow pressures on affected borrowers, improve their capacity to service debt, increase the potential for financially stressed residential borrowers to keep their homes, and facilitate the financial institution's ability to collect on its loans. When working with borrowers, lenders and servicers should adhere to consumer protection requirements, including fair lending laws, to provide the opportunity for all borrowers to benefit from these arrangements. The agencies expect that supervisory feedback for institutions will be focused on identifying issues, correcting deficiencies, and assuring appropriate remediation to consumers. The agencies do not expect to take consumer compliance public enforcement action against institutions, provided the circumstances were related to the national emergency and that the institution made good faith efforts to support borrowers and comply with the consumer protection requirements, as well as responded to any needed corrective action. The CARES Act only covers federally backed mortgage loans and borrowers experiencing a financial hardship due directly or indirectly to the COVID-19 emergency. Under the Act, borrowers could request forbearance by making a request to their mortgage servicer and affirming that they are experiencing a financial hardship during the COVID-19 emergency. Servicers were required to provide a CARES Act forbearance, allowing borrowers to defer their mortgage payments for up to 180 days and possibly longer. During 2021, for credit unions that service mortgages covered by the CARES Act, NCUA examiners will assess the credit union's compliance with the relevant parts of the Act. This will include, but not be limited to, verifying required notices were given to borrowers who sought relief under the CARES Act, such as the 5-day acknowledgement notice given after receipt of an incomplete application, and that required actions were taken, such as sending the annual escrow statement. However, examiners will not criticize credit unions for failing to do so within the required time frames. During the emergency, the NCUA has encouraged credit unions to work with borrowers to restructure their debt obligations where beneficial to the borrower. When doing so, credit unions were advised that they should comply with federal and state consumer financial protection requirements, including fair lending laws, and supply borrowers with accurate disclosures for all loan modifications. Credit unions that do not sell their loans on the secondary market were better able to use creative temporary and permanent loan modifications to assist borrowers. Examples of temporary modifications used by credit unions include payment forbearance, waiving late fees, waiving modification fees, offering interest-only payments, and reducing the interest rate. Examples of permanent loan modifications include consolidating loans, extending the maturity date, reducing the interest rate, forgiving principal, and various other restructurings of notes. NCUA's 2021 examinations will assess whether credit unions considered the borrower's ability to repay the debt, particularly at the end of the temporary accommodation period, especially if the modification results in higher payments or a balloon payment. In addition to considering a borrower's ability to repay after a loan modification and prior to providing the relief, credit unions should have ensured borrowers were aware of the terms of any modification and the potential impact on the loan balance and future payment. Additionally, examiners will determine whether credit unions complied with the applicable Truth in Lending Act and Regulation Z and RESPA and Reg X disclosure requirements for covered modifications and ensure that the modifications and documents did not contain any unfair, deceptive, or prohibited provisions. Which provisions of the regulations will be implicated by the temporary and permanent loan accommodations will be dictated by the terms and conditions of the modification. Accommodation options for non-mortgage consumer loans may be similar to those for mortgage loans. There could be additional options due to the fact that a mortgage is not attached to the loan. This might present challenges depending on the state laws. Reviews of consumer loans will be similar to mortgage loans in that examiners will assess whether credit union efforts were conducted in a reasonable manner with proper controls and oversight. Examiners will determine whether the accommodations were appropriate for the borrower's needs and degree of hardship, and whether the credit union made sure the borrower understood the terms of the modification and any impact on the loan balance and future payments. Examiners will review a sample of loans to determine whether credit unions complied with the applicable Truth in Lending Act and Regulation Z disclosure requirements for covered modifications. Loan document reviews will ensure that the modifications and documents did not contain any unfair, deceptive, or prohibited provisions. As with the loan accommodation reviews, current examination procedures extend to a credit union's procedures and controls for reporting loans in forbearance to the credit reporting agencies. In that regard, during the 2021 reviews, examiners will confirm that with regard to loans not otherwise reportable as past due, credit unions are not designating loans with deferrals granted due to the COVID-19 as past due because of the deferral. The start date of the period for reporting coverage is January 31st, 2020. A loan's payment date is governed by the due date stipulated in the legal agreement. If a credit union agrees to a payment deferral, this will result in no contractual payments being past due, and these loans are not considered past due during the payment of the period of deferral. However, should a borrower become delinquent under the modified loan terms and conditions, credit unions will report the loans accurately to the credit bureaus as past due. This slide contains links to the two interagency statements I mentioned a few minutes ago and a link to NCUA's webpage with coronavirus-related resources. Thank you for your time, and now Matt Nixon will speak on fair lending.
Thanks, Lisa. Good afternoon. I'm Matthew Nixon. I'm a program officer in the NCUA's Office of Consumer Financial Protection. Today I'll discuss observations based on recent cases the NCUA has referred to the Department of Justice for patterns or practices of lending discrimination. The Equal Credit Opportunity Act and its implementing regulation, Regulation B, require federal financial regulatory agencies, including the NCUA, to refer matters to the Department of Justice when the agencies have a reasonable belief that the creditor in question has engaged in a pattern or practice of discrimination in violation of the Equal Credit Opportunity Act. It is important to note that the NCUA must make the referral to the Department of Justice even if there was no conscious intent to discriminate by the credit union. From 2017 to present, all but one of the cases the NCUA has referred to the Department of Justice has been for either discrimination on the basis of marital status or discrimination on the basis of age. Additionally, all cases in the pipeline being considered for referral are either marital status or age cases. The marital status cases all share common characteristics, as do the age cases. I will discuss those common characteristics today. Marital status and age are protected under the Equal Credit Opportunity Act. With limited exceptions, some of which I'll discuss today, creditors cannot consider an applicant's marital status or an applicant's age in any aspect of a credit transaction. Except as otherwise permitted or required by law, a creditor must evaluate married and unmarried applicants by the same standards. And in evaluating joint applicants, a creditor cannot treat applicants differently based on the existence, absence, or likelihood of a marital relationship between the parties. If, under a creditor's standards of creditworthiness, the personal liability of an additional party is necessary to support the credit requested, a creditor may request a cosigner, guarantor, endorser, or similar party. The applicant's spouse may serve as an additional party, but the creditor cannot require that the spouse be the additional party. A creditor may consider the marital status of an applicant or joint applicant for the purpose of ascertaining the creditor's rights and remedies applicable to the particular extension of credit. For example, in a secured transaction involving real property, a creditor can take into account whether state law gives the applicant's spouse an interest in the property being offered as collateral. If it does, a creditor may require the signature of the spouse on any instrument necessary under applicable state law to make the community property available to satisfy the debt in the event of default. A creditor's consideration of state property laws, directly or indirectly affecting creditworthiness, does not constitute unlawful discrimination under the Equal Credit Opportunity Act or Regulation B. When two applicants or signers are involved in a lending transaction, some credit unions are applying different pricing guidelines based solely on the applicant's or signer's marital status in violation of the Equal Credit Opportunity Act. For example, when two applicants are involved, some credit unions are pricing loans based on the higher of the two applicants' credit scores when they are married and based on the primary applicant's credit score when they are not married. With few exceptions, creditors cannot take into account an applicant's age, provided the applicant is of legal age to enter into a binding contract. If a creditor uses an empirically derived, demonstrably and statistically sound credit scoring system, age may be used as a predictive variable as long as applicants aged 62 years or older are treated at least as favorably as applicants who are under age 62. An empirically derived, demonstrably and statistically sound credit scoring system is, one, based on data that are derived from an empirical comparison of sample groups or the population of creditworthy and non-creditworthy applicants who applied for credit within a reasonable preceding period of time. Two, developed for the purpose of evaluating the creditworthiness of applicants with respect to the legitimate business interests of the creditor utilizing the system. Three, developed and validated using accepted statistical principles and methodology. And four, periodically revalidated by the use of appropriate statistical principles and methodology and adjusted as necessary to maintain predictive ability. In a judgmental system of evaluating creditworthiness, a creditor cannot decide whether to extend credit or set the terms and conditions of credit based on age or information related exclusively to age. Age or age-related information may be considered only in evaluating other pertinent elements of creditworthiness that are drawn from the particular facts and circumstances concerning the applicant. For example, a creditor cannot reject an application or terminate an account because the applicant is 60 years old. But a creditor may consider the applicant's occupation and length of time to retirement to ascertain whether the applicant's income, including retirement income, will support the extension of credit to its maturity. A judgmental system of evaluating creditworthiness is defined as any system for evaluating the creditworthiness of an applicant other than an empirically derived, demonstrably and statistically sound credit scoring system. In any system of evaluating creditworthiness, a creditor may consider the age of an elderly applicant, that is, someone who is age 62 or older, when such age is used to favor the elderly applicant in extending credit. A credit union may not disqualify a loan applicant for automatic loan approval based on the applicant's age if the applicant is of legal age to enter into a binding contract. Such a practice violates the Equal Credit Opportunity Act and Regulation B, even if the credit union subsequently approves the application following a manual review of the application file. Such a practice directly considers age in the credit union's evaluation of creditworthiness and does not meet any of the exceptions mentioned on the previous slides. The NCUA includes a number of fair lending resources on its website, including a fair lending guide and the examination procedures used by NCUA's fair lending examiners. Regulatory guidance referenced in this portion of the webinar is available on the Electronic Code of Federal Regulations website. That concludes my portion of today's webinar. I will now turn it over to Program Officer Al Brantley to discuss this year's Consumer Compliance Exam Scope activities. Al?
Thank you, Matt. Consumer financial protection is a vital element of member service. Therefore, NCUA examines for consumer compliance with applicable laws and regulations during regular examinations. The scope of each examination's consumer compliance reviews are risk-focused based on each credit union's compliance record, products and services offered, and any new or emerging concerns. Each year, NCUA identifies specific consumer financial protection laws and regulations required to be reviewed during examinations when applicable to the credit union. Issues or violations are usually attributable to weaknesses in one or more areas of the credit union's compliance management system, or CMS. Compliance expectations also extend to third-party relationships. Why is CMS important? It helps you manage risk with product and service offerings, as well as new laws and their implementing regulations. Non-compliance may lead to informal or formal administrative actions, litigation by affected members, and elevated reputation risks for the credit union. In 2020, NCUA examiners completed targeted reviews to evaluate compliance with consumer financial protection areas listed on this slide: Electronic Fund Transfer Act and Regulation E, Fair Credit Reporting Act, Payday alternative loans and small dollar loans, Late Fee Practices, Truth in Lending Act and Regulation Z, Military Lending Act, and Servicemembers Civil Relief Act. Since our time is limited today, I'm going to spotlight common issues or violations we've observed in each of these areas. We'll take a high-level look at each area to get an idea of what examiners have been citing and addressing during their examinations. This is knowledge, some knowledge that I'm going to present today is something you can't get anywhere else, but it could help you in preparing for your next exam. Among other things, Regulation E requires a credit union to provide certain disclosures and to comply with the error resolution procedures a consumer properly asserts an error. The term error generally means an unauthorized electronic fund transfer. It can also mean an incorrect transfer to or from a member's account, or a computational error made by the credit union in connection with the transfer. A few other types of transactions are covered by the regulation, as well as some examples of what the term error does not mean. In this area, examiners found that one or more credit unions violated Regulation E by failing to provide all of the applicable initial disclosures, including, but not limited to, a summary of the member's liability for unauthorized electronic fund transfers, and the type of transfers the member may make, such as those initiated by mobile phone and by ACH, and any limitations on the frequency and dollar amount of such transfers. The law requires you to provide initial disclosures at the time a member contracts for an electronic fund transfer service or before the first transfer is made involving the member's account. You must provide any disclosure that is applicable. In response to examiners' findings, the credit unions agreed to revise their initial account disclosures. Examiners found that one or more credit unions violated Regulation E by failing to investigate promptly and, except as otherwise provided in the regulation, determine within 10 business days of receiving a notice of error whether an error occurred. Examiners found a uniform 90-day time period for completing an investigation based on an error notice involving any type of electronic fund transfer. In some cases, the investigation exceeded 90 days. The law requires you to provisionally credit a member's account if unable to complete an investigation within 10 business days. By provisionally crediting the account, you may generally take up to 45 days from receipt of an error notice to investigate and determine whether an error occurred. Under certain conditions, the 10-day and 45-day investigation timeframes can be extended. In response to examiners' findings, the credit unions agreed to revise their error resolution procedures and promptly close out certain open investigations. Examiners found that one or more credit unions violated Regulation E by failing to report the results to the member after completing an investigation. The law requires you to correct any error within 1 business day after determining an error occurred. Results of the investigation must be reported to the member within 3 business days after completing the investigation. If you determine no error or a different error occurred, you must report the results of your investigation and include a written explanation of the findings. Such notice must state the member's right to request the documents you relied on in making your determination. In response to examiners' findings, the credit unions agreed to revise their error resolution procedures and other internal controls. If your credit union has violated Regulation E procedural requirements, then you likely need to improve your compliance training and monitoring programs. A consumer report, generally called a credit report, may often contain inaccurate or incomplete information. The Fair Credit Reporting Act and Regulation V govern the collection and reporting of credit information about consumers. In this area, examiners found that one or more credit unions, those who furnish information about its members to one or more consumer reporting agencies, violated Regulation V by failing to establish and implement adequate policies and procedures. The law requires a furnisher to establish and implement reasonable written policies and procedures regarding the accuracy and integrity of member information provided to a consumer reporting agency. If you're a furnisher, you must consider the guidelines in Appendix E to Regulation V in developing or updating your policies and procedures. In response to examiners' findings, the credit unions agreed to develop policies and procedures or to revise existing policies and procedures to implement the purpose of the Fair Credit Reporting Act. Examiners found that one or more credit unions that report delinquent and/or charge-off information about its members' accounts to a credit bureau violated the law by failing to give account holders the one-time notice stating the credit union provides negative information to a credit reporting agency. Model notices are available in the regulation. In response to examiners' findings, the credit unions agreed to send members with past due loan accounts the one-time notice about reporting negative credit information. If your credit union has violated any of the FCRA or Regulation V requirements, then you likely need to improve your compliance training and monitoring programs. NCUA's rules and regulations establish specific criteria and limits federal credit unions must follow when making PALS 1 and PALS 2 loans, and also contain guidance and best practices for both products. The term small dollar loan generally refers to an unsecured loan with a small principal amount. If you make non-PALS small dollar loans, you must comply with the provisions in Section 701.21 of NCUA's rules and regulations, other than the Payday alternative loan provisions. In this area, examiners found that some credit unions making PALS 1 or PALS 2 loans violated NCUA's regulations by failing to address in their loan policies all of the prescribed criteria and limits for Payday alternative loans, such as membership requirement and concentration limit. NCUA's regulations impose a minimum 1-month membership requirement for a PALS 1 loan, while they impose no membership requirement for a PALS 2 loan. Additionally, a credit union must establish a limit on the aggregate dollar amount of PALS 1 and PALS 2 loans that can be made. This limit cannot exceed 20% of the credit union's net worth. In response to examiners' findings, the credit unions agreed to amend their loan policies for PAL loans. Examiners found that some credit unions violated NCUA's regulations by charging a member an application fee greater than allowed for either a PALS 1 or PALS 2 product. The only fee allowed is a reasonable application fee, but it cannot exceed $20. Such fee should reflect the actual costs associated with processing the application, such as obtaining a credit report, but it must not exceed $20. In response to examiners' findings, the credit unions agreed to amend their loan policies and procedures for PAL loans. They also agreed to reverse or refund the fee overages charged to members. Those of you who do not offer PALs may be offering other small dollar loan products. Examiners found that some federal credit unions failed to cap the interest rate charged on originated non-PAL short-term small dollar loans. The Federal Credit Union Act and Section 701.21 of NCUA's regulations limit the loan rate on a non-PAL small dollar loan to 18% per year on the unpaid balance, inclusive of all finance charges. In response to examiners' findings, the credit unions agreed to amend their loan policies and procedures for non-PAL loans. They also agreed to reduce the loan rate, amend the loan agreement, and refund overcharges to affected members. If your credit union has violated any of the PAL or small dollar loan requirements, then you likely need to improve your compliance training and monitoring programs. Regulation Z implements the Federal Truth in Lending Act. Its purpose is to promote the informed use of consumer credit by requiring disclosures about its terms and costs to ensure consumers are provided with greater and more timely information on the nature and cost of credit offered or extended for personal, family, or household objectives. In this area, examiners found that one or more credit unions violated Regulation Z by parameting late fees in connection with a closed-end consumer credit transaction secured by a member's principal dwelling. Examiners found inadequate data processing controls when multiple payments are made in the same month for the current amount due on a mortgage loan. Each payment left an overdue balance and resulted in another late fee. In response to examiners' findings, the credit union sought an automated solution through their core data processing systems or third-party service providers. The credit unions agreed to refund the overcharges to affected members. Examiners found that one or more credit unions violated Regulation Z by failing to include in the separate written itemization of amount financed certain payments to other persons made by the credit union on behalf of the member. Examiners also found amounts paid to other persons incorrectly disclosed as funds given to the member or placed in an asset account. The law expects you to disclose accurate and complete information as applicable to the transaction. In response to examiners' findings, the credit unions agreed to correct the violations. Examiners found that one or more credit unions violated the law by failing to include in the finance charge certain amounts payable directly or indirectly by the consumer as a condition of receiving the loan. Examiners found the APR to be inaccurate and outside of the applicable tolerance. In response to examiners' findings, the credit unions agreed to correct the violations and make restitutions to affected members. If your credit union has truth in lending issues or violations, it signals the need to improve your compliance training and monitoring programs. The Military Lending Act, or MLA, is implemented by the Department of Defense, or DoD, regulation at 32 CFR Part 232. It contains limitations and requirements for certain types of consumer credit extended to active duty service members, their spouses, children, and other dependents. The Servicemembers Civil Relief Act, or SCRA, provides protections for military members as they enter active duty and permits interest rate reductions on real and personal property loans granted prior to entry into military service. Some of the provisions of the law also apply to spouses and dependents of service members. Examiners considered various factors in assessing for MLA and SCRA compliance. Although you are not expected to have separate policies for these laws, you should be familiar with them and ensure compliance with the DoD regulation. Failure to comply with either law could result in civil money penalties, punitive damages, and for the MLA, possibly voiding of a loan contract. Examiners found that some credit unions had inadequate policies and procedures to implement compliance with the MLA, such as in determining covered borrower status and in performing due diligence for loans subject to credit-related ancillary products. Examiners observed incidents of loans miscoded or not coded in the core data processing system, signifying deficiencies in staff training and in monitoring covered accounts. In response to examiners' findings, the credit unions agreed to revise their policies and procedures and to review all loans granted to service members and properly match them with the applicable law. As part of your overall CFS, you should have a suitable training program to ensure employees and volunteers are properly educated on the applicable provisions. This slide shows a number of resources available to assist you and your credit union. I do want to thank you for your attention this afternoon. This concludes my presentation, and I will now yield the mic back to Grace.
Thank you, Al. And now it's time to answer some of your questions. Al, we have a question for you. It's about FCRA and specifically the special one-time notice requirement. So the question is, could you elaborate on the negative credit reporting notice and when we are required to provide this notice?
Yes. Every credit union that sends negative information to a nationwide consumer reporting agency must provide the notice in writing to the consumer. The Fair Credit Reporting Act requires you to provide the notice, but you're only required to do so one time. It must be provided to your member prior to or no later than 30 days after the first time you furnish negative information. After providing such notice, you may submit additional negative information to a CRA with respect to the same member without providing additional information or notice to the consumer. One caveat here, if the notice is provided to your member prior to furnishing negative information, the notice may not be included in initial disclosures provided for open-end consumer credit plans. Otherwise, the notice may be included on or with any notice of default, any billing statement, or any other materials provided to the consumer. The notice must be clear and conspicuous. Appendix B to Regulation V, which is 12 CFR Part 1022, provides two model notices. One can be used prior to furnishing negative information, while the other one can be used after furnishing such information. Back to you, Grace.
Thank you, Al. Lisa, it looks like we have a question for you. Here it is. If the member's loan was already past due at the time of forbearance, should credit unions continue to report the member's loans as past due to the consumer reporting agency?
Thanks, Grace. Yes, they should, but only to the extent that the loan was past due at the time of the loan accommodation. If the credit obligation or account was delinquent before the accommodation, during the accommodation, the furnisher cannot advance the delinquent status to reflect the accommodation. For example, if at the time the credit union grants the loan payment forbearance, the member was 30 days past due, the credit union may continue to report the loan for 30 days past due. It may not report the loan as 60 or more days past due just as a result of the accommodation. Also, if during the accommodation the member brings the credit obligation or account current, the credit union must report the credit obligation or account as current. This could occur, for example, if the accommodation itself brings the credit obligation or account current, such as if the loan modification resolves the amount past due so the borrower is no longer considered delinquent, or if the consumer makes past due payments that bring the credit obligation or account current. Conversely, if the member fails to perform under the loan accommodation and does not make payments as required under the revised loan terms, the borrower may be reported as delinquent. Thanks for the question.
Thank you, Lisa. Matt, we have a question for you. You use the term pattern or practice of lending discrimination when describing referrals to the Department of Justice. What is a pattern or practice of discrimination?
Thanks, Grace. I can provide some general comments about the term pattern or practice and how it's applied to fair lending referrals. However, I should mention up front, the Department of Justice issued a memo a number of years ago, and the memo is available on their website, which addresses lending discrimination referrals to the DOJ. The memo discusses pattern or practice standards in detail. So to anyone interested in a full explanation of the term, I recommend you go to the DOJ's website and pull down the memo. That said, the meaning of the term pattern or practice of discrimination has been addressed by courts, but there is no single definition of the term. Courts have said it means more than an isolated instance. There is no minimum number of incidents which must be proven as a prerequisite to finding a pattern or practice, but the term generally means it was a regular rather than an unusual practice to act in a discriminatory manner. Proof of a pattern or practice of discrimination does not require a showing that age or marital status or whatever protected class was the sole motive for the creditor's actions. Rather, if age or marital status or another protected class is a motivating factor in the actions, then illegal discrimination exists.
Thanks, Matt. I have another one for you. If the NCUA refers the credit union to the Department of Justice for lending discrimination, what does that mean? What does the Department of Justice do with the referral?
When any regulator, including the NCUA, refers a case to the DOJ pursuant to the requirements of the Equal Credit Opportunity Act, the Department of Justice evaluates the case and makes a determination whether to initiate an independent investigation, take legal action against the creditor, or defer action on the referral. When considering legal action, the Department of Justice may evaluate such factors as whether the practice has ceased, how many victims were involved, and the amount of financial harm involved. If the Department of Justice decides not to open an investigation or pursue legal action, it will instead defer on administrative enforcement to the referring agency. In referrals which the DOJ defers, the NCUA will work with the credit union on required corrective actions.
Thank you, Matt. Al, I have another question for you. It's about Reg E, specifically reporting the results of an error investigation. The question is as follows. Could you further explain the reporting requirements after completing an investigation to determine whether an unauthorized EFT occurred in a member's account? When must we report the results? How may it be provided?
Thank you, Grace. Under Regulation E, you must report the results to the member within 3 business days after completing your investigation. If you determine the error occurred as alleged, you may provide the required notice to your member either orally or in writing within 3 business days of making the determination. A written correction notice can also be placed on a periodic statement that is mailed or delivered within the 10 business day or 45 calendar day time limit for completing the investigation. But bear in mind, if you choose this method, you must determine whether such mailing will be prompt enough to satisfy the requirements of the regulation, taking into account the specific facts and circumstances involved. If you happen to determine that the error occurred in a manner or amount different from that described by your member, and you notify your member orally, you still must provide a written explanation of your findings to your member within 3 business days after completing your investigation. You must also inform the member of their right to request the documents that you relied on in making your determination. Upon request, you must promptly provide copies of the documents. You may give the notice of correction and the explanation separately, or it can also be combined together in one form. Remember, if you determine that an error occurred, you must correct it within 1 business day. Back to you, Grace.
Thank you, Al. Matt, I have another question for you. How does NCUA examination and insurance determine which credit unions have a fair lending exam? By total asset size alone? Are NCUA fair lending exams for the remainder of 2020 and into early 2021 all done remotely?
Thanks for that question, Grace. The NCUA's Office of Consumer Financial Protection considers a number of factors when determining which federal credit unions will receive a fair lending exam. We consider recommendations from NCUA district examiners. We look at HMDA data and evaluate HMDA outliers. We will look at Regulation B, Regulation C, Fair Housing Act violations that have been cited in regular examinations. And among other factors, we do consider asset size. And on occasion, we will schedule a fair lending exam based solely on asset size. And I believe the second part of the question was about whether our exams are being completed remotely. We are currently performing all fair lending exams remotely, and that will continue into 2021. The NCUA has not made a determination on when on-site exams will resume.
Thank you, Matt. I think we have time for one more question, and Lisa, this is for you. Basically, the question asks if we can no longer give the best rate to a couple with the highest FICO score. If so, which score does the ACT recommend we use?
Thanks, Grace. I actually think that this is Matt's question. Thanks.
Yeah, can you repeat that, Grace?
Sure. Basically, it's asking, so can we no longer give the best rate to a couple with the highest FICO score? If so, which score does the ACT recommend we use?
Yeah, I don't fully understand I don't know what the reference to the ACT is. I don't know if it's talking about the Equal Credit Opportunity Act or something else. The basic guidelines within the Equal Credit Opportunity Act is that a creditor may not consider a protected class or a prohibited basis in any aspect of a credit transaction. So under ECOA, marital status is protected. Unless there is an exception to the rule, creditors may not consider applicants' marital status when pricing a loan.
Thank you, Matt. It looks like our time is up. Here is our office contact page. Thank you for attending today's webinar. Goodbye, everyone.